Welcome friends, welcome to yet another session on financial instruments, and in this session we are going to cover embedded derivatives. So let's begin. So guys, before we talk about embedded derivatives, it is important to understand what exactly is a derivative. So we have already uploaded a couple of videos on our YouTube channel with regard to derivatives. The first one being derivatives forwards and futures, and the second one is options and swaps. So guys, in these videos we have already discussed the definitions of derivative, the characteristics of derivatives, how a derivative is measured. We also talk about forward contracts, future contracts, option contracts, and swap contracts along with the help of example. It is highly recommended that you view these videos in order to better understand what an embedded derivative is. We will take a couple of slides to understand what exactly is a derivative, and then we will move forward to embedded derivatives. Okay, what exactly is a derivative? We have already discussed this in earlier videos that a derivative is a financial instrument whose value is derived from the value of another asset, which is also known as the underlying. There are three characteristics of derivatives as defined in the accounting standards. Derivatives fair value changes in response to changes in one or more underlying variables. Second, there is no or very little initial net investment that is required. And third, these derivatives are settled at a future date. Also, we discussed that derivatives are measured at fair value. That is, any change in fair value needs to be recognized in profit and loss, except for hedge accounting. We have also understood what a hedge accounting is and how hedge accounting is measured at. There are some exceptions in hedge accounting where the changes in fair value need not be presented in profit and loss. Instead, these are recognized in other comprehensive income. So you can view the videos on hedge accounting as well. So guys, let us now discuss about what embedded derivatives are. So embedded derivatives are financial instruments included in non-derivative contracts such as loan agreements or insurance policies. So guys, you can view it in the diagram that there is a hybrid instrument which consists of embedded derivatives along with the host contracts. So these derivatives are embedded within the host contract and these cannot be traded independently. The value of an embedded derivative is derived from an underlying variable such as interest rates, foreign exchange rates, or commodity prices. So this IND 109 requires that entities to recognize and measure these embedded derivatives separately from the host contract under certain conditions. So we'll talk about those conditions in the subsequent slide. However, it is important to know that a derivative attached to a financial instrument but contractually independent of that instrument or with a different counterparty is not considered a embedded derivative but a separate financial instrument in itself. I'm again repeating, a derivative attached to a financial instrument but contractually independent of that instrument, that is, the derivative is independent of that instrument or with a different counterparty. This will not be considered as embedded derivative, but it will be considered as a separate financial instrument. So guys, let us now discuss few examples of embedded features that are added to the host contracts. What exactly are host contracts? Host contract can be a lease contract, it can be a debt instrument, executory contract, equity contract, foreign exchange, and insurance contract. And what are embedded derivatives which are added to these host contracts? This can be a forex option, interest rate index, commodity index, and equity index. Guys, let us see a couple of examples wherein we will see what a host contract is and what is an embedded derivative. Example number one, company A holds a bond which is convertible into the ordinary shares of company B. So company A has a bond which is convertible into the ordinary shares of B. Here bond is a host contract and the option to convert bond into shares is the embedded derivative. Let's take another example. Company A enters into a lease contract with an inflation factor such that each year rentals are adjusted for changes in risk price index, that is RPI. So guys, in this example, lease contract is the host contract and the adjustment to RPI, that is risk price index, is the embedded derivative. Let us take another example. Company A sells PPE, property, plant and equipment, to company B for USD 1 lakh. Both companies are in India. Since both companies are in India, their functional currency is rupees. However, the transaction is into USD. So guys, in this case, the sale of contract, that is sale of PPE to company B, is the host contract, and the fluctuations in INR versus USD foreign exchange is the embedded derivative. So guys, we have also understood earlier that Ind AS 109 requires these embedded derivatives to be separated from the host contracts. So let us now understand what are the separation conditions prescribed by Ind AS 109. So Ind AS 109 says if the hybrid contract contains a host that is an asset within the scope of this standard, then embedded derivatives are not separated for accounting purposes. This means that the classification criteria of Ind AS are applied to the entire hybrid contracts. So guys, let us first understand what are classification criteria, then we'll come back to this. Guys, we have already discussed this in our earlier videos on the financial instruments classification, wherein we have discussed that financial assets are broadly classified as amortized cost, fair value through OCI, that is other comprehensive income, and fair value through profit and loss, that is FVTPL. There are two factors which need to be considered. One is the business model and second is the SPPI, contractual cash flows. So SPPI means solely payment of principals and interest. So if the business model is to hold to collect the contractual cash flows, that is SPPI, then the financial asset will be classified as amortized cost. However, if the business model is to hold and collect and the SPPI contractual cash flow test is also passed, then the financial assets are measured, are classified as fair value through other comprehensive income. If the asset is held for trading or is a residual category, that is not classified as amortized cost or as fair value through OCI, then it will be classified as fair value through profit and loss. We have already discussed these factors along with the help of example in the videos on financial instrument classification. So we are not going to discuss in detail for the purpose of this session. So guys, let's come back to our conditions. Ind AS 109 says if the hybrid contract contains a host that is an asset within the scope of this standard, that is Ind AS 109, then embedded derivatives are not separated for accounting purposes, which means that the classification criteria of Ind AS, that is financial assets are classified as amortized cost, fair value through OCI or P&L, are applied to the entire hybrid contract. However, if the hybrid contract contains a host that is not an asset within the scope of 109, an embedded derivative has to be separated from the host contract and accounted for as a derivative if all the following conditions are satisfied. So guys, in short, if the hybrid contract contains an asset, contains a host that is an asset within the scope of 109, then embedded derivatives are not separated. However, if the hybrid contract contains a host that is not an asset within the scope of 109, then these embedded derivatives has to be separated from the host contracts. So India's 109 has prescribed three conditions which need to be fulfilled for this criteria. What are these conditions? First, the economic characteristics and risk of the embedded derivatives are not closely related to the economic characteristics of the host contract. What accounting standard says? Economic characteristics of embedded derivatives are not closely related to the economic characteristics of the host contract. If these are closely related, then these need not be separated. Because these are not closely related, these has to be separated. Number two, condition number two, A separate instrument with the same terms as embedded derivatives would meet the definition of a derivative. If there is a separate instrument with the same terms and conditions as are there in the embedded derivatives, then this would meet the definition of a derivative, and as such it has to be separated from the host contract. Condition number 3, the hybrid contract is not measured at fair value with changes in fair value recognized in profit and loss. This means that a derivative embedded in a financial liability valued at fair value through P&L is not separated. So if it is an embedded derivative in a financial liability which is valued at fair value through P&L, then it is not separated. So guys, all these three conditions have to be met. There is no random order or ad hoc order which needs to be fulfilled. All these three conditions have to be fulfilled. Then only it will be separated from the host contracts. So guys, let us understand this with the help of a flowchart. Number one condition, these are not in any particular order. Is the embedded feature clearly and closely related to the host contract? And if the answer is no, that means these are not closely related. We will see if the hybrid instrument accounted for as fair value through P&L. If no, does the embedded feature meet the definition of a derivative? If the answer is yes, does the embedded feature qualify for a scope exemption from derivative accounting? If there is no such scope exemption, then we will have to separate the embedded derivative from its host contract. Let us discuss again. Is the embedded feature clearly and closely related? Answer is no. These are not closely related. As such, it's need to be separated. Second condition, is the hybrid instrument accounted for at fair value through P&L? No, it meets the second condition. Let us now look at the third condition. Does the embedded feature meets the definition of a derivative? Answer is yes. Then we will see if there is any scope exemption from derivative accounting. If the answer is no, then we will have to separate the embedded derivative from its host contracts. Let us look from the other point. Is the embedded feature clearly and closely related to each other? Answer is yes, means these cannot be separated. Is the hybrid instrument accounted for at fair value through P&L? If the answer is yes, then it need not be separated. Does the embedded feature meet the definition of a derivative? Answer is no, it does not meet the derivative. Does the embedded feature qualify for a scope exemption from derivative accounting? If the answer is yes, then we need not separate the embedded feature from the host contract. So guys, all these conditions have to be met to fulfill the criteria. It is not that one condition is met and the second and third condition is not met. All the three conditions has to be met. So guys, now that we have understood the separation criteria, let us assume that the separation criteria have been met. Now there is a need for a separation. So what exactly will be the value of my embedded derivative? If an entity is unable to measure reliably the fair value of an embedded derivative, if an entity is unable to measure reliably the fair value of an embedded derivative, then we will first see what is the fair value of the hybrid contract. Then we will see what is the fair value of the host contract. So when we have the fair value of the hybrid contract and we also have the fair value of the host contract, the fair value of the embedded derivative will be, we will deduct the fair value of the host contract from the fair value of the hybrid contract. That means fair value of the total hybrid contract minus the fair value of the host contract, which is a portion of the hybrid contract, we will get the fair value of the embedded derivative. However, IND AS 109 also says, if an entity is unable to measure the fair value of an embedded derivative using this method, then the entire hybrid contract is designated as fair value through profit and loss. So if we can measure the fair value of a hybrid contract, if we also have the fair value of the host contract, that is these are reliably measured, then we will deduct the fair value of the host contract from the fair value of the total hybrid contract to arrive at the fair value of the embedded derivative. If the value is not reliably measurable using this method, then the entire hybrid contract is designated as fair value through profit and loss. Guys, let us now look at couple of examples where a separation is required and the examples where the separation is not required. So we'll first have a look where the embedded derivatives required separation. In this example, RAM Limited issues bond in the market. So RAM Limited has issued some bond in the market. The payment of the coupon and principal component of the bond. There are two components in a bond. One is the payment of the interest, that is the coupon, and the payment of the principal component. The payments are indexed with the price of the gold. So in this case, RAM Limited has issued the bonds and the payments of coupon as well as the principal components are indexed to the price of the gold. So in such scenario, cost of the coupon will increase or decrease in direct correlation with the price of the gold in the market. So guys, in this example, my bond is a debt instrument, which is a non-derivative contract and it is a host contract. And the prices are linked or indexed with the prices of gold. The derivative component is the prices of gold and this is my embedded contract. Now we will see whether the economic criteria are closely related or these are not closely related. So as you can see, debt instrument versus gold, there are no economic or risk criteria that are closely related. As such, the embedded contract, that is the derivative component, needs to be accounted for separately. So there is no correlation between the economic and risk characteristics of a debt instrument and the economic and risk characteristics of a gold. So these are not closely related. As such, the embedded contracts need to be accounted for separately. So guys, let us now look at an example where embedded derivatives does not require separation. Rentals for the use of leased assets and adjustments for inflation on similar kind of properties are considered to be clearly and closely related because it's a similar property. So the risk characteristics are closely and clearly related. Thus, the inflation related derivative instrument embedded in an inflation index lease would not be separated from the host contract. So let us now look at another example. A company leases property and the lease payments require an adjustment that is based on 2 times the changes in CPI. This embedded derivative is not clearly and closely related to the host lease contract because it is leverage, that is 2 times the change in CPI. Therefore, it should be accounted for separately. Alternatively, if the lease payments were only adjusted for the changes in CPI with no leveraging, then the embedded derivative would be clearly and closely related and therefore would not be accounted for separately. So guys, with this, we have concluded the session on embedded derivatives. I hope you have understood the embedded derivatives with the help of an examples. So guys, we will be back with some more videos. Till then, stay tuned.